Welcome back to the deep dive. You know, when we talk about the whole digital economy, we tend to focus on the shiny objects.
Right.
We obsess over the software giants, Microsoft, or the cloud guys like Amazon, or the chip designers like NVIDIA and Apple. They get all the headlines.
They do. They're the ones we see on our screens every day. It's only natural to focus on the end product.
Exactly. But today we're going deeper. We are looking at the absolute bedrock of it all, the one company that is the undisputed gatekeeper for all of them. The company that, if it just decided to take a long vacation tomorrow, the entire global advancement of computing would just freeze.
And it sounds like hyperbole when you say it like that, doesn't it? But it's really just a statement of fact. There is no plan B for the digital world. If this company stops, Moore's Law stops.
We're talking, of course, about ASML. And the timing for this deep dive, well, it couldn't be better. It is Thursday, January 29th, 2026, and ASML just released their Q4 2025 earnings.
And released is, putting it mildly, they dropped a sledgehammer on the market.
They really did. To say the market is reacting is a bit of an understatement. So here's our mission for today. We're going to unpack these blowout numbers because they tell us a lot about the state of AI. We're going to geek out respectfully on the physics-defying tech that creates their monopoly. And then we're going to open up the valuation and try to figure out if the stock is actually worth buying now or if we've all missed the boat.
Which is the big question, right? This isn't just an earnings report. It's like a litmus test for the entire AI industry.
It really is. But before we get into the billions of euros and the molten tin droplets, which, trust me, we will get to, we should probably talk about the market context.
Right.
We're talking about bubbles and cycles today, and I know a lot of you want to keep a finger on the pulse of the broader market without, staring at a Bloomberg terminal all day.
Of course, because ASML doesn't exist in a vacuum. You need to know if the water's boiling before you decide to jump in.
Exactly. So for a really easy way to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store. You can get daily alerts just to monitor for market bubbles.
That's pretty handy.
Yeah, given the massive numbers we're about to discuss, knowing where the broader market is, it's a good tool to have.
Absolutely. Context is everything.
Okay, so let's get into that context. Let's unpack this Q4 report. The word shocking gets thrown around a lot in financial news, usually for like a 2% beat or something. But there was one number in this report that genuinely seemed to stun Wall Street. What was it? It
was the net bookings. It's essentially the order book, the contracts they've signed for machines they'll deliver in the future. Now, coming into the quarter, the consensus estimate from analysts, the so-called smart money, was that they'd book about $6.3 billion in new orders.
Okay, $6.3 billion. That's a solid number.
Yeah.
Pretty standard for them lately, right?
Right. The actual number was $13.2 billion.
Whoa, okay, hang on. That's more than double the estimate. How do highly paid analysts get something that wrong?
Well, it happens because these orders are incredibly lumpy. These aren't impulse buys. These machines cost hundreds of millions of euros. A single big order from a TSMC or a Samsung can swing the needle by billions.
So it's about timing.
It's about timing. But still, a beat of this size, it signals something very specific.
What does it signal? Because to me, that smells like a bit of panic buying.
It's not far off. It signals FOMO, fear of missing out from the giants. When bookings jump like that, it means the big players, your TSMCs, your Samsungs, your Intels, they're locking in capacity for the next 18 to 24 months.
So this is the proof.
This is the definitive proof that all the talk about AI demand is now translating into hard infrastructure spending. They are writing billion-euro checks.
So this kind of kills the AI is a bubble argument, doesn't it? At least from the hardware side.
It certainly makes it a lot harder to argue that demand is drying up. And if you look inside that $13.2 billion, it gets even more telling. 56% of those orders, about $7.4 billion, were for EUV systems.
Extreme ultraviolet, that's the really cutting-edge stuff.
The absolute bleeding edge. So this confirms the demand is for the 2-nanometer chips, for advanced AI memory. This isn't about making more chips for your car. This is about building the brains for the next wave of AI.
And the full-year numbers for 2025, they look incredibly healthy. Total sales of, $32.7 billion, net income of $9.6 billion. But the number that always gets me is the gross margin, 52.8%.
That is the power of a monopoly. A 52.8% gross margin for a company that makes heavy hardware. It's almost unheard of. Apple has margins like that, but they sell phones. ASML builds machines the size of a bus.
Which means they have immense pricing power.
They have ultimate pricing power. They can pass on any cost, any inflation, and their customers just have to pay it because, well, where else are they going to go?
That's the perfect transition. Why can't anyone else build these machines? I mean, we have rockets that land themselves. Why is ASML the only game in town for this?
This is where we have to dive into the physics because it honestly sounds like science fiction. To make a modern chip, you need to etch features that are incredibly small. We're talking 13.5 nanometers wide. To do that, you need a very specific kind of light, extreme ultraviolet, EUV.
Okay, so they need a really special light bulb.
Oh, if only it were a light bulb, it'd be so much cheaper. But you see, nature doesn't really want to make EUV light here on Earth. It gets absorbed by everything, even air. So to make it inside the machine, they have to do something insane. They take microscopic droplets of molten tin.
Molten, the metal.
The metal, and they drop them through a vacuum chamber. Then they fire a super high-power CO2 laser at that tiny droplet. But here's the kicker. They don't just hit it once, they hit it twice.
Why twice?
The first little pulse flattens the droplet into a pancake, just to increase the surface area. Then the second, main pulse, slams into that pancake and vaporizes it into a plasma. That glowing plasma is what emits the EUV light.
Okay, that sounds complicated.
It happens 50,000 times per second.
I'm sorry, did you say 50? 50,000 times a second.
50,000 times per second. They are sniping a falling drop of metal with a laser continuously for weeks at a time. It's basically a strobe light made of tiny explosions.
That is absolutely mind-bending. I can barely hit a golf ball when it's just sitting there.
It is, and we haven't even gotten to the mirrors. Once you make the light, you have to guide it.
Yeah.
And you can't use glass lenses, they just absorb the light. So you have to use mirrors. But not just any mirrors. These are made by their key partner, Carl Zeiss, in Germany.
I love this analogy. Just walk us through how smooth these things are.
Right, so these mirrors are so unbelievably flat that if you scaled one up to the size of, say, the entire country of Germany.
Okay, so from one end of Germany to the other.
The biggest bump or dip on that entire surface would be less than 1 millimeter high.
So it's basically perfect.
It is as close to perfect as humans can engineer anything, and that is the moat. It took them decades and billions of euros to figure this all out. A competitor can't just copy it. They'd have to replicate that whole supply chain. The Zeiss mirrors, the lasers. It's almost impossible.
So ASML has a 100% market share in EUV. There's no one else.
Not even a distant second place.
And they're not stopping, right? The Q4 report talks about high NA EUV. Is that just a small upgrade, like an iPhone 16 to a 17?
No. This is a whole new platform. Yeah. NA is for numerical aperture. Basically, it lets you focus the light even tighter. Think of it like a better camera lens.
Which lets you print even smaller lines on the chip.
Exactly. The current machines are 0.33 NA. The new ones, the EXE 0.52 Euro series, are 0.55 NA. It's a total re-engineering of the optics.
Yeah.
A beast of a machine.
And the price tag, I'm guessing, is also beastly.
Over 350 million each.
That's the price of a jumbo jet.
It is. And yet Intel is rushing to get them first to try and leapfrog TSMC. The growth for the next 5 years is all about high NA.
So the tech is secure. The monopoly is secure. But let's pivot to business strategy. You can't talk about chips without talking about the elephant in the room, China.
It's been a huge part of their sales. In 2024 and 2025, China was over 40% of their business. They were just buying up all the older DV systems they were allowed to, stockpiling before sanctions got tighter.
But the guidance for 2026 sees that dropping a lot.
Drastically. They're guiding for China's sales to fall back to about 20% of revenue in 2026. Now, normally if you lose half your business from your biggest customer, you're in for a world of pain.
But they're guiding for growth in 2026. Revenue between 34 and 39 billion. How does that math work?
That's the pivot. The demand from everywhere else, Taiwan, Korea, the US, is so strong, driven by that AI boom, that it completely makes up for losing that China bubble.
So they're swapping out lower-end China sales for high-end AI sales.
Exactly. And it's a much healthier business mix in the long run. The high-end machines have better margins and much stickier service contracts.
Speaking of efficiency, I saw a note about job cuts. The new CEO, Christophe Fouquet, is cutting about 1,700 jobs. Why cut staff if you're growing?
It's a shift in philosophy. The last few years, the mantra was growth at all costs. Just hire everyone to get machines out the door. Fouquet is moving to efficient scaling, so the cuts are mostly in management and support roles, not the engineers. The idea is to get leaner and faster.
Okay, so let's talk about the money itself. The business model has this really clever part, the installed base management.
Yes, IBM. It's the unsung hero of their financials. When ASML sells a machine, that's just the start. Those things are so complex, they need constant maintenance and software updates to keep hitting that 50,000 shots per second.
So it's basically a subscription model.
It really is. It's an annuity that lasts for 20 years. In 2025, that business segment brought in $8.2 billion. That's super profitable, recurring revenue that smooths out the bumps in the chip cycle.
That brings us to a concept you love, and it ties back to our Buffett app, Owner's Earnings. Because net income isn't always the full story.
It rarely is. With accounting, you have to deduct Depreciation, which for ASML is huge, around $4 billion.
Because their factories and tools are so expensive.
Right. But depreciation isn't actually cash leaving the building. What we care about is maintenance capex, the real cash they spend just to keep things running. And for ASML, that's much lower, more like $1.5 billion.
So the accounting makes them look less profitable than they actually are in cash terms.
Precisely. If you take their net income of $9.6 billion, add back that big depreciation number, then subtract the actual maintenance spending. Their true owner's earnings are over $12 billion.
So the PE ratio might look high, but on a cash basis, it's cheaper than it seems.
Exactly. It's a cash printing machine.
So let's get to the bottom line. Is the stock a buy? We're looking at the report's DCF model here. What are the key assumptions?
Okay, so the model uses a 9.5% discount rate, a WACC.
9.5% seems a little conservative now for a monopoly like this.
You could definitely argue for a lower number, which would push the valuation way up, but 9.5% bakes in a nice margin of safety. They also use a 3% terminal growth rate, basically assuming AI keeps the industry growing forever.
Which feels like a safe bet, so what's the number?
With those inputs, the base case intrinsic value comes out to about 667 euros per share.
And where is it trading today?
It's hovering right around that number, so it's not on sale. But the bull case, if high-NA adoption is perfect, could push the value up towards 830 euros.
So upside potential, but you're not getting a bargain today.
You're paying a fair price for a fantastic company. But they did announce a new 12 billion share buyback.
That helps.
It creates what we call synthetic growth. Even if profits are flat, your earnings per share still go up because the share count goes down. It's very shareholder friendly.
Okay, this all sounds a little too perfect. What could go wrong here? What are the real risks?
Geopolitics is still number one. We talked about sales restrictions, but the real nightmare is a restriction on servicing the machines already in China.
Oh, right. You can't just let them break down.
If the U.S. government says they can't fix the machines that are already there, China's chip industry grinds to a halt. That would be a huge escalation, a form of economic warfare, really.
And what about the supply chain, those Zeiss mirrors?
That's the single point of failure. If that one factory in Germany has a fire, the entire global tech industry stops. There is no backup supplier. It's an incredible bottleneck.
Crazy to think about.
It is. And the last risk is just cannibalization. If TSMC finds a clever way to keep using the older, cheaper machines for a bit longer, they might delay buying the new 350 million toys. That would hit ASML's growth.
So not risk-free, but when you step back, what's the final verdict?
The verdict is that ASML isn't really a hardware company. It's a royalty on human technological progress. If you believe computers will be faster in 10 years, then ASML has to succeed. The future literally runs through their machines.
A royalty on progress. I like that.
It is. But I'll leave you with one final thought to chew on.
Let's hear it.
ASML is currently priced for perfection. The valuation assumes this AI supercycle lasts until 2030, a smooth line going up and to the right. But if AI is more like the dot-com bubble, where there's a pause in the infrastructure build-out, ASML stops being a growth rocket and just becomes a utility.
And a very, very profitable utility.
A great utility, for sure. But utilities don't get the same premium valuation. The market is betting on a seamless revolution, and history shows us revolutions are rarely seamless.
A sobering thought to end on. We'll definitely be watching to see how that demand holds up. Now, before we sign off, just a quick reminder for everyone, full deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe to us on deepvalues.com.